In today's video, I'm going to take a quick look at some of the weekly charts. Uh, all right, so I said in some of my previous videos that I didn't think we were going to get a sustained breakout above this peak, although I did think there was a good possibility we could test it or marginally go above it, which is what we did. But it looks to me like there's just still too much space between price and this 200-week moving average for us to be ready to take off to the upside yet. I think just more work's going to have to be done, and I'm not even convinced at this point that we've got an intermediate cycle low, even though we're clearly moving down into one, and we got a nice reversal save on the market yesterday, and they're trying to push it higher today. Um, they want to paint the charts for the end of the month, but um, I think this intermediate cycle decline is going to have to go deeper. It's going to need to get closer to this 200-week moving average. I think we still need to chew up some more time, allow this average some more time to rise, catch up to price before we're going to be ready to get a sustained breakout above this level and a strong trending move higher. We got the same problem with the NASDAQ. Again, a marginal breakout to new highs. The smart money, institutional money, use that to sell their shares to retail traders that were buying this breakout. It's a familiar topping pattern and bottoming pattern for that matter. And again, it just seems to me that there's just too much space between price and this 200-week moving average. I think we need a deeper correction. I would really like to see something that could come down here to about 7,000. That would be, at that point, I might be willing to try and pick a bottom. I'm not willing to try and pick a bottom just yet here. And we don't really have any sentiment extremes either. And I tend to try to lean against the crowd when sentiment becomes too excessive, but it's not really excessive right now. It's just kind of middle of the road, and that's not generally where I like to try and take contrary trades. So 2018 was a year of sideways. 2019 may also be a year of sideways here, and I think we're going to have to go a little deeper on this intermediate correction before we're going to get a more lasting bottom. I may be wrong, and maybe the plunge protection team steps in and stops the ICL right here, but I'm not willing to make a bet based on the government trying to alter the natural flow of the markets. I would prefer to see a more natural correction, something that pulls back a little deeper, generates some sentiment extremes, and then at that point I would be more inclined to enter a long position, but not at this point, I don't think. And then we have the semiconductor index, same problem, just stretched way too far above this long-term moving average. I've been saying for months that it was just too late in the intermediate cycle for us to expect a sustained breakout above this level. The 2000 high was about 1360. We've been testing it back and forth on either side of it all of 2018. We get a nice correction. Didn't quite pull back to the long-term mean. Semis were a little stronger than the general stock market, and they've been a little stronger during the rally. We got a breakout above this, but again, just too late in the intermediate cycle for it to be sustained. Said at the time we were almost certainly going to have to come back and retest that this support and resistance zone, and that's what we're doing. And I would like to see more of a pullback here as well. Even a double bottom on the semis would be nice. Something that can come down and test this 200-week moving average, full test. I don't know if it's going to do it or not, but if it did, that's where I would be interested in trying to pick a bottom. Not really interested in trying to pick a bottom right now. And realistically, I think we're going to have to get a resolution to the trade war in order for the S&P to um, break out above those all-time highs and produce a sustained move. I don't see the market being able to do that without a signed trade deal, and I think we've gone far beyond the ability of tweets and such to have any chance of moving the market higher. We've cried wolf enough times. I think now we've got to see results, and without results, I think we're going to stay stuck in this sideways chop that we've been in since the beginning of 2018. Now, the other thing that might be able to drive um, a sustained breakout on the stock indexes would be if the Fed starts a rate cutting cycle. But right now, there's no cover to do that. The market we'd have to continue, a crash event, something that brings the S&P back down to maybe test or even undercut those December lows. If that were to happen, then I think the Fed would have cover to cut rates, and that might be enough of a driver that we could get a sustained breakout even without uh, a final trade deal in the trade war with China. But I just don't see that being on the board as of now, not unless we get severe crash in the stock market in the coming next week or two. And if that happens, then maybe. But as of right now, anyway, I don't think that option is on the board, and we seem to be getting further away from a trade deal. So as of right now, it just looks like 2019 is probably going to be kind of stuck, going sideways, just like 2018. And we're just going to need to chew up some more time and allow these long-term moving averages more time to catch up to price.